So know your risk measurements and don't be tempted to take on more volatility than you can handle. Look at this guy here. He's about to jump onto this fund. I'm going to show you in a second. The CGM Focus Fund, the high risk portfolio. And then you have Scott here trying to talk him out of it. Says, I have a better idea. Let's take this cab ride in this diversified portfolio. And Scott's the wise one in that picture right there. Because this is Ken Hebner. He was once America's hottest investor. This was May 27, 2008. Never mind the rocky market, after a string of super smart calls, mutual fund manager Ken Hebner is putting up the best numbers of his sterling career. And then Wall Street Journal wrote, that was December 31st, 2009, meet the decade's best performing U.S. diversified stock mutual fund, Ken Hebner's $3.7 billion CGM Focus Fund, which rose more than 18% annually, outpaced its closest rival by more than 3 percentage points. 3 percentage points per year, 18% per year. Give me some of that, right? Too bad investors weren't around to enjoy much of those gains. The typical CGM-focused shareholder lost 11% annually during the 10 years. Investors underperform the investments they actually invest in. Why? Because when it goes up, after it went up, they get in. Then this, I'm going to show you in a second, has tremendous volatility. It goes down, they get out. They lose money permanently. We're not recommending this fund, by the way, and you'll see why. Money manager Ken Hebner, a hot touch, gone cold. This was June 24th, 2010. Hebner, CGM Focus, one of the best performing mutual funds, has lagged its rivals since 2008. And 7 years later, he's still lagged his rivals. So he was super smart back then. Has he all of a sudden become dumb? I don't think so. I think he's probably still a pretty smart guy. This guy's probably brilliant. But he takes big risks with his clients' money. This is what people saw, the plus 79%. I want that, after some good returns. And then all of a sudden, minus 48, and then another one right after that, minus 26. And then here's his most recent returns. He had another one, I'll show you in a second, plus 37, and then some lackluster performance. This is what investors saw. This was the 10 years when he got all those articles written. And then investors make the mistake of assuming, based upon a chart, wow, this guy's been doing it for 10 years. This is reasonable to assume that he can keep doing that. That's a 10-year track record. Well, this is the first 10 years, that's the next 10 years. Okay, these money managers that take big risks get lucky every now and then. And then investors don't buy in until after they got lucky. And then they get unlucky. Look at his standard deviation. You know what yours is now on your chart that I gave you. But this is off the charts. A 25 on the standard deviation. I think our aggressive is around 13 or something, 14, something like that. And then look at the beta, 1.5. That is very, very high. Investors saw the 79%. They didn't know they were hopping on an aggressive roller coaster. They didn't pay attention to these risk measurements. Plus 79, minus 48, plus 37, plus 1, minus 4, and then early 2016, the markets were down around 12. He was down 18. Finished the year plus 9, I think, or something like that. Not spectacular for an aggressive fund. So know your risks so you know what to expect.